Listen up, primates. Imagine a company preparing for one of the biggest IPOs in history. Investors are excited. The valuation is reportedly around $852 billion. The business is growing, and the technology is changing the world. So why are major executives suddenly leaving? And more importantly, what can a beginner investor learn from it? Let's break it down. Before we talk about Openai, let's understand one basic investing term. IPO. IPO means initial public offering. It's when a private company sells shares to the public for the first time and becomes publicly traded. Why does that matter? Because once a company becomes public, ordinary investors can potentially buy its shares through the stock market. But here's something beginners need to remember. A famous company does not automatically mean it's a good investment. You still have to look at the business, the valuation, the risks, and the numbers. Now let's talk about that $852 billion valuation. This is one of the most important concepts for beginners. Valuation is basically what the market believes a company is worth. But here's the trap. A company can be worth hundreds of billions on paper and still be overvalued. Think about Bitcoin. Bitcoin can have a massive market capitalization, but that doesn't automatically tell you whether today's price is cheap or expensive. Same principle applies to stocks. Big number doesn't mean bargain, so you keep. Investors have to ask, what am I paying compared with what this business can actually deliver? Now we get to the big story. Openai has experienced several high-profile executive departures. This week, Chief Revenue Officer Denise Dresser left. That came just days after longtime executive Brad Lightcap announced his departure. And there have been other major exits as well. Does that automatically mean Openai is failing? No. And this is an important lesson. Beginners shouldn't look at one headline and immediately scream, sell. Instead, ask, what does this tell me about the company's risk? Leadership affects strategy, execution, hiring, sales, and ultimately the ability of a company to turn technology into profits. So executive turnover is a signal to investigate, not automatically a buy or sell signal. Here's where things get interesting. Despite the executive shakeup, Openai is reporting strong business growth. The company said its enterprise business reached around 2 million customers, doubling from the previous year. And Greg Brockman reportedly told employees that run rate revenue increased more than 20% month over month in July, with business customers growing 32%. That's why investors need to look at both sides of the story. Bad headline? Yes. But potentially strong business momentum? Also, yes. This is what investing actually looks like. It's not about finding a company with zero problems. It's about understanding whether the potential reward is worth the risks you're taking. There's another lesson here for both stock and crypto investors. Never analyze a company in isolation. Openai isn't operating alone. It's competing with companies like Google and Anthropic, while cheaper open-weight AI models are also becoming more important. In crypto, it's the same. You don't evaluate Bitcoin, Ethereum, or another token without understanding the competition, adoption, technology, regulation, and market demand. A great product can still lose if the competition becomes better, cheaper, or faster. So here's your commission desk lesson. When you see a viral financial headline, don't just react. Ask 5 questions. 1. What's the business worth? 2. How does it make money? 3. Is revenue actually growing? 4. Who are its competitors? 5. What risks could destroy the investment thesis? That's how you move from being a spectator to becoming an investor. And remember, hype tells you what everyone is talking about. Research tells you whether you should care. Stay dangerous. Stay invested.